Welcome to the REI Foundation Podcast, where we cover all the steps and strategies to make your real estate dreams a reality. Now your hosts, Jason and Peely.
Well, hello again. This is Jason from the Real Estate Investing Foundation Podcast with Jason and Peely. Thank you so much for checking in with us again and listening. And if you like what you hear today, please go to iTunes and give us a 5-star rating and review. And also you can find us on YouTube. We have a very special guest today. Very happy to welcome Andrew Cushman to the show. Andrew, how are you?
I'm doing well. Glad to be here.
Good. Well, thank you so much for being with us. And a little more about Andrew. Andrew has run a real estate investment business full-time for the past decade after leaving his corporate job in 2007, just, of course, before the Great Recession began. Andrew has completed 24 single-family transactions, purchase, rehab, sell, all of which have had significant returns for both the business and investors. And then in 2010, he made a major shift, transitioning to the acquisition and repositioning of multifamily properties, and has successfully acquired and repositioned 1,796 multifamily units to date. Wow, that's pretty impressive. Andrew, welcome to the show.
Oh, glad to be here. It's been an interesting journey.
Sure has. So, we could touch on a lot of different things there, but let's just go back to the start, because I don't know if you hadn't anticipated that Great Recession, or you're finding things just ticking with the market, but you made a jump out of your job in 2007. So what was it that really got you started in real estate?
Yeah, ever since I was a little kid, I wanted to run my own business and do my own thing. I just had no idea what that was going to be. And so I got an engineering degree just to do a job that would pay decent and be something I could tolerate until I figured that out. And then, so I got married. My wife had the same mentality. We tried a variety of little businesses that, made some money, but were really just kind of replacement jobs, like vending, or we tried flipping cars, of all things, even though we have no clue about anything but the cars. That probably would have been disaster. So I'm thankful it didn't work. We didn't get too far down the road. We tried making flavored popcorn in our house and destroyed the kitchen, made some good tasting stuff. But again, we're like, okay, this is going to be a lot of work. So one day, saw an article in the Wall Street Journal about someone flipping houses, and went and looked up the person who had taught them how to do it. And my wife and I said, well, geez, this is something we think we could probably do. And just did a ton of research, and then went and learned it, and said, all right, this looks like something, we decided that was the next thing that we're going to try. And, me being an engineer, my phone skills, talking on the phone, weren't the best. And so we, naturally went into a business that relied on cold calling people in financial distress. So what we were doing is we were reaching out to people who were in pre-foreclosure, or, about to lose their house to the bank. The bank hadn't taken it yet, but they said, we're coming for it. And so I call them and say, hey, I'm a stranger. Let's talk about your financial problems, which, everyone's always happy to do that. And so it took, 4,576 calls, I think it was, to actually get that first deal. But when we did get it, we fixed it up and resold it, and we made as much as I made all year at my job. And so we said, all right, this is it. There's no better time than now. My wife was still working, so when I could quit and we could still have some income. By selling that first flip, we had a year of my income in the bank, and we said, you know what, this gives us some cushion. This gives us the ability to go ahead and cut my cord corporately and try to go for this full time. And that's what we did. 2 years later, after the flips were going a little more consistently, my wife quit also and became full-time real estate investor. And we did do that knowing the recession was coming. Everyone thought we were absolutely crazy, but we kind of looked at it contrarian and said, well, if we're going into a recession and with everything locking up and all the problems that there's going to be, there's not going to be any other buyers. We're not going to have any other competition. And that really was the case. I mean, we could go out and buy stuff at 50 cents on the dollar and sell it at 80 cents on the dollar all day long. And it was, from that perspective, it was a great few years to be in real estate.
Absolutely. And so were your parents entrepreneurial? Where did you get this sense of entrepreneurship?
When I was 5 or 6 years old, we'd go visit my grandfather. He lived down on Cape Cod in the summers, and then he lived near a golf course. And so every weekend we'd go down, and he would take me. We'd walk around the golf course and collect all the balls that were in the bushes and the trees. And then I'd go back and I'd polish them up, and I'd take my little red wagon and go sell them back to the guys who lost them the day before. Right. And I remember one day I made $17.50, and there's actually a picture of me holding it. And, as a 5-year-old in, the early 80s, that's a ton of money. And so I think that just kind of instilled on me, my parents weren't entrepreneurs, but they're always very hard workers. They're always disciplined financially. And so, those things all just kind of came together. So.
Absolutely. Yeah. Because I actually went to Lehigh University, a ton of engineers there, and sometimes the analysis to death happens. So especially this, I see it very to the point, 4,576 calls, 1,700, 1,796 units. I love the numbers there, but sometimes it paralyzes people from taking action. What was it that allowed you to mentally step over that and say, okay, I'm going to quit my job today versus I'm going to wait another month or another 2 months or another week? Was it the opportunity that you saw with the market, just how great that one deal was? What was it that you said, I'm doing it right now?
When we started the process, we said we will not quit until we do at least one deal. And then after that, if we don't like it, then we can quit. The only thing that's truly failure is just quitting without doing anything. So we gave ourselves that option. So once we did the deal, we realized, okay, we're not good at this, but we still made it happen. We can get better at it. Now that we've done a flip, we have, some income set aside. I definitely wouldn't recommend anyone go out and run out and quit their job and then say, okay, great. Now how do I start in real estate? I mean, that 1 out of 100 people might be able to do that and survive, but for most, that's probably not the best idea. So we had already proven the business model, and as a result, we had some cash to operate off of. And then there's a certain point at which you just have to do it. You'll never see every step on the ladder all the way to the top. You might see the top, and so you just have to start taking the first step, the next step. Think of it like driving down a foggy highway, right? You can't see 10 miles down the road where you're going, but you can see 100 feet. So you go 100 feet. Well, now guess what? Now you can see the next 100 feet. And we realized that that's how we had to do it. And then also, we looked at what's the worst thing that could happen and what's the best thing that can happen. The best thing that can happen is something similar to where we are, and that's 11 years later, we still have our own business. Now we're buying large commercial properties, which back then, if you had said, hey, you're going to buy a $10 million apartment complex, that would have been, yeah, right. How is that going to happen? Other people do that, not me, right? So again, I couldn't even see the end of the ladder. We realized, that's the best that can happen. Well, what's the worst that can happen? Well, the worst that can happen is we burn up all the money we made from the first flip, and I have to go back and get another job again, right? I mean, that's the worst thing that was going to happen. So weighing those two against each other and realizing the worst case scenario usually doesn't happen, and it's also usually not as bad as you think it's going to be. We said, what? The upside outweighs the downside. There's not going to be a better time. Just do it. I mean, and it wasn't, my arms were shaking when I walked into my boss's office and told him I was going to be leaving soon. It still wasn't, it wasn't necessarily easy. We're still a little fearful of doing it. But it just came to a certain point of, the potential benefits outweighed the potential risks.
And I have to recap on that because that was priceless, because that's something that everybody needs to look at when they're in a position, is just set out the worst case scenario, what could possibly happen, and then of course the best side scenario. And then you also gave yourself that we're going to do one deal before we quit. And that's huge, because sometimes everybody thinks about it, but they don't give themselves actionable steps. And that one deal, that's awesome. Thank you for that.
Yeah, that was our agreement with each other. We were not allowed to quit no matter how hard it was until we did one. Then if we decided it wasn't worth it, fine.
So you read this article in the paper, you said, we're going to start cold calling pre-foreclosures, which of course is not that easy, of course.
Knocking on doors and windows and yeah.
So, how'd you learn to do it? Did you have a mentor? Were you watching other people do it? Or what was it that gave you the steps? And I guess that could lead into our multifamily conversation, is that how'd you learn to do it? Was it trial and error, or were you following what other people were doing?
Yeah, I'm a big fan of, okay, so in the corporate world where I came from, R&D stands for research and development. What I like to say is R&D stands for rip off and duplicate. And I don't mean that in the malicious sense. What I mean is especially in real estate, everything's been done before. Real estate's very creative, but you're not going to do anything new that someone else hasn't already done. So go find somebody that's already figured it out, that's already executing at a high level, and learn what they're doing, and then go duplicate it, right? So that's what I mean by R&D. So that's what we did. I'm not a big fan of the gurus, but I also wouldn't completely throw them all in the trash. I think the truth is somewhere in the middle. So for the single family pre-foreclosure business, we actually found a local mentor that just taught small classes of like 10 to 12 people on how to do it. So we went and attended that class, and then we hired a coach that was associated with her, who was doing the business full time. We verified that was his full-time thing. He was doing really well, exactly what we wanted to do. So we hired him as a one-on-one coach. And so we every I forget the timing, but every week or 2 weeks or whatever it was, we'd get on the phone, we'd go over what we had done the previous time period, the results. I'd ask him email or call him with questions. Okay, so homeowner told me this. How would you respond? And so we had constant feedback. And then also my wife would be sitting there listening to me make phone calls. And I'd get off the phone and she'd be like, all right, honey, that was good, but next time, why don't you try this instead? So it was just, we constantly I had an in-house coach and then a professional hired coach. And so when it came to multifamily, it was the exact same thing. It was 2010, and we had just had a really good year in 2009. And we said, this is great, but it's not going to last forever. The markets are going to change, the equity's going away. And we said, well, we really think apartments are going to be the next big thing to start a positive cycle. And so we just went to our mentor for the single family and said, hey, we think apartments are going to be the next thing that we should get into. Do you know anybody that we could learn the business from? And he actually said, yeah, I do. And he connected us with a guy who had already purchased about 800 units. And we hired him and the same thing, I don't remember the timing, but for a year basically. And every month or whatever, we had a scheduled call, and then we'd get deals or we'd look at deals and go over them. And he coached us and mentored us through our first acquisition, which was a 92 unit vacant, almost fully vacant property on the other side of the country, which I don't recommend anyone do as your first deal, and learn that way. And then we got along so well that we ended up becoming business partners. I think total we've done 5 or 6 deals together, and then we've done like 8 or so more separately. And we've been doing apartments full time, I guess 6-7 years now. 7 years, yeah.
And which is awesome about that, and one of the great things about coaching and mentoring, of course, you want to vet your coaches, make sure they're not just teaching it, they're actually doing it, but just the accountability factor. You're having these weekly or bi-weekly calls, you're getting back on the phone with them, telling them what you're doing. And if you get on that call and just say, oh, we haven't done anything, you're just basically wasting his time or wasting her time, and vice versa. So
exactly. Well, and also it helps you get over the fear of doing that first deal. Right? When you've got somebody experienced to walk you through it and kind of hold your hand. It's still scary, but for us, I don't know if we probably would not have bought a 90 plus unit property as our first one without somebody, really guiding us through it. And that was all syndicated. We didn't have the money to go do that. But it probably likely wouldn't have happened without someone to kind of guide us through.
Yeah, absolutely. Especially almost fake it. It takes a little bit of effort right there.
Yep.
In regards to how your business has evolved since that first purchase, talk to us about where you set your sights on multifamily today, what you're doing with today's market, and where you're pushing your business going forward.
Yeah, we've shifted a little bit. Now, in the beginning, we were kind of distressed C assets. Now we're more like C plus to B assets. And we look at what I call stabilized value add, meaning the day we buy it, it's well occupied, it cash flows. We could do nothing to it and still be profitable. But if we spend $3,000, $5,000, $8,000 a unit, we can increase rents maybe $100, $125, and in some cases actually closer to $200 a unit. And so now we've forced appreciation and value in those properties. So one of the reasons we like that is we can get higher returns, but then also that sets us up to have a safe, low basis in the property in case, we get a recession in the next, it's a matter, my crystal ball is just as foggy as everybody else's. I don't know when the next recession is coming. It's just, they come. And it could be something internally. It could be trade wars. It could be, a European nation collapses. Who knows what it's going to be? It'll happen eventually. And so this far into the cycle, we, instead of saying, all right, great, we can get this much upside, the first thing that we do, and I would recommend anyone does, whether it's single family or multifamily, is first evaluate what's the potential downside. Meaning, when a recession comes, how is this property going to perform? How is this neighborhood going to do? How are the economic drivers in this town going to withstand a recession, right? If they're military, education, and medical, they're probably going to do okay because those things tend to not really be affected by a recession. So we say, first, when we're looking at property, we say, well, what's the potential downside? If we think the potential downside is minimal, or at least has some cushion, then we say, well, what's the potential upside? And then if we like the upside and think the upside is greater, then that's a property that we might be interested in. And again, we're focused more on the kind of the B class space, because in a recession, the really expensive luxury stuff, people who, if they're not sure of their jobs, they're not sure of their incomes, they start moving down. And then also in a recession, the very low end, the C class stuff, your kind of minimum wage, the first jobs that companies tend to cut are those. They're going to hang on to their highly skilled, educated workers, but the people that are just doing kind of the very, the lower end stuff, they tend to cut those jobs first. Or, those people, unfortunately, a lot of those folks are just barely hanging on, week to week to week. And if they get their hours cut by 25%, they can't make the rent. So now they're going to go move in with mom and dad or double up. Or anyway, so those properties tend to suffer. So that's kind of where and why we're focusing.
So what state are you located in?
I'm in California. We invest in Texas, Georgia, the Carolinas, and North Florida.
Awesome. And for people that are, I know people that are scared to invest 10 minutes from themselves. How can you find a market that is thousands of miles away and feel comfortable? What's your high level criteria to basically identify a market and build out a comfort level there that you want to invest?
First, I'm going to recommend a book by actually, he's a friend of mine, David Green. He's called Long Distance Real Estate Investing. It's a thick book, but it's because there's a ton of information in there. I would recommend anyone who's having trouble getting over the investing out of your backyard fear, which is it's legitimate, and I would recommend reading that book, because he in very detail goes through how to set everything up to overcome that, and it really applies to single family or multifamily. But basically, with 15, 20 years ago, it was a different game. Especially that's kind of like the running real estate joke is the California investor comes out to Ohio and we're going to sell him some crap houses and he's not going to know the difference, right? Well, that's basically what happened. Well, now with everything on the internet, every piece of data you could ever want is accessible, from sitting at your desk looking on your laptop in your pajamas and coffee, right? And then like what you can also do is you can do things like have people, we'll get on like Skype or something and just do a live video walkthrough of a property. Right. So we've had situations where their apartment complexes, let's say maybe there's a major plumbing issue or a major repair that was unexpected. It's as simple as have the contractor, live feed on their phone and walk it through, which is 90% as good as being there. But the real key is, So you asked how do we identify the markets? So the main thing we're looking for is population growth and job growth. And ideally, it's going to be markets that have those two things that greater than the national average. So if the national average for population growth or our job growth is 1.9 and we see a metro that's 2.5 or 3.2, then that metro is probably going to do better than the rest of the country. Same thing for population growth. For example, I think between the last two censuses, and the data is getting a little old, but I think the U.S. as a whole grew by 9.7% population-wise. The last city that we just purchased a property in over that same time period had a 10-year growth rate of like 29%, right? So it's growing 3 times as fast as the country as a whole. So if you've got people and jobs moving into a market, then that's going to keep your property full. And those are the two biggest things that are going to lead to a successful multifamily investment.
Love it. And when you're going into these markets, what are some of the team members you're trying to surround yourself with to make sure you have the most successful investment?
The most important one by far is your property management company. Because the best deal in the world can be ruined by bad management. And so it's absolutely key to have good property management. And so that's the most important one.
Would you have some questions before we jump onto the others to vet a property management company?
Yeah, actually, I haven't used it in a while because we've kind of have our established relationships, but actually, yeah, I've got a questionnaire with like 27 questions or something like that on there. But how I find the property management company is I talk to brokers and lenders and other owners and get referrals. And so ideally is maybe I talk to 8 different people and say, give me if you were going to buy a B-class property and, maybe you're looking at C or fill in the blanks for what you're doing, right? If you're going to buy a B-class property, 100 units in this town, who would you hire to manage it? Who are the top 2 or 3 property management companies you would hire to manage it? I go through that process with, 5, 6, 7, 8 different people. And ideally, the same couple of companies are going to keep coming up over and over again. And so then I build a short list of 2 to 3. And then I will do phone interviews with those companies. Generally, I try to do it with the owners. And then maybe in addition to that, someone mid-level, because the regionals are going to have a big effect on your property. And then I'll narrow it down to, let's say, maybe like 1 or 2. And then I'll go out and physically, go to dinner with them. And that dinner is an interview. And then I'll select the management company that I'm going to use. And so the actual questions I'm asking, though they might change depending on what your goals are, but I'm going to ask things like, well, do you just do third-party management, or do you own and do third-party management? What kind of property best fits your management style, right? You don't want a company that says, oh, we do everything, because that means they're not going to do any of it well, right? So like, for example, the company that we work with, their specialty is C+ to B+. Right? And that's all they do. And they only do 100 units on up. Well, that matches exactly what we do. And they do it exceptionally well. So that's why there's a whole list of questions that helps make sure that their interests are going to be aligned with our interests and that they're going to be a good fit. And so, over time, I've hired 2 property management companies, and the one ended up being phenomenal, and the other one ended up being okay. They kind of turned out to be glorified babysitters, meaning if you hand them a property, they'll keep it going, but they're not going to really maximize its potential. And so we ended up letting them go and bringing the other company in, and now that one company manages everything for us, and they do an excellent job.
Well, that's a great topic. So how long would be long enough to give a property management time to try and prove your concept before you say, okay, I got to move?
It kind of depends on the state of your property when you get it and how many moving pieces you have. But generally, that's probably one thing. I probably took too long to make the switch to the other management company. And part of it too is they started off strong. The previous company started off strong, but then over time started getting weaker and weaker. So I would say as soon as you realize things aren't being done the way that either you want them done or that they need to be done or that goals aren't being met, then it's time to make a change. Making the change is always painful, but the quicker you get it over with, the better off you're going to be. And that applies to the management company or the actual manager on site or really any of the staff as well.
Absolutely agree. And what would you identify as other key members that you have in the market as your team?
Lenders. Definitely lenders, because without a good lender, your deal's not going to close. And with a bad lender will put you in a world of hurt, because they'll, unfortunately, I've seen it where everything's great, and then 2 days before closing, oh yeah, our committee kicked this deal out. It's like, well, it's no skin off their back, but you're holding the bag with legal costs and a $100,000 deposit, right? That's so. So a good lender is critical. A good insurance broker is important. Good contractors, obviously, is another one. But those and all of these people it's the same process, right? I'll ask. Again, I'll go back to those brokers. I'll go to the lender. I'll go to the management company. Say, who are some of your best contractors? And you kind of use all the different team members to refer. Like when you're trying to find a new team member, you use the other team members to give you referrals to figure out who the best team person is for the spot you're trying to fill. So it's really the same process. But a good contractor is absolutely critical. And then, of course, we talked about the management. The property manager and the maintenance guy that actually work on your property are key. That is one place I would advise everyone do not try to save money, especially these days, is by paying low wages. You will get what you pay for. And the amount that we budget for wages has gone up dramatically in the last 2 to 3 years as the market has tightened, but we found it's absolutely worth it. A really good manager will make your deal succeed. A mediocre or poor one will not, and then you'll lose them to someone else down the road who offers them 50 cents more an hour anyways.
Awesome. And that's all great for building out your team. And now let's talk about, you get the property and you find the property, you get under contract and you close. What are some ninja tricks that you're doing right now to maximize your property?
What we do is we try to focus a lot on cosmetic upgrades where the return on investment is as high as possible. So we're generally not moving walls and taking things down to the studs and bringing them back up. We kind of like to minimize the risk as well. So, number one is we actually try to have the contractors lined up to start work the day after we close, right? So generally with a multifamily in particular, you've got usually, give or take, a 30-day due diligence and then 30 more days to close. That gives you 60 days. During that 60 days, we are working furiously with our contractors. So by the time we close, the scope is laid out, the materials are spec'd, contracts are signed. They can be there the next day after we close and get working. So a quick start. That's one of the things that we always aim for. The other thing I see a lot of people miss is, you see these beautiful properties, they're well rehabbed, and you walk on site and the landscaping is horrible, right? It's dead, or they never put it in the first place. They haven't mowed, they haven't mowed the grass in 4 weeks, and there's dandelions and clovers and weeds and all kinds of things growing everywhere. We always do a big landscaping package, and on a 100-unit property, I'd say on average we'll spend $50,000-$60,000 on a landscaping package, because that sets the tone and the look for your entire property. Because if prospects and applicants and people who are looking at your community, if they don't like and feel good about the outside, they're never going to even care about going to see the inside. So you can have $20,000 interiors, but if your landscaping is horrible, it's going to be a waste. You're going to lose return on what you did on the interior. So exterior is huge. That means your monument signs, your signage looks really nice and professional, probably a level above. If you've got a C property, put in a B-class sign, right? Because someone drives by and they see that sign, they go, oh, this is a B-class property. If you've got a B-class sign and a B-class landscaping, they're just going to treat your property as if it's a B, even though it might not really be one. So those are some of the little things like adding shutters to windows, right? Of course they're fake. No one actually does real shutters anymore. But it's very you might pay, depending on your windows, anywhere from $75 to $150 a set. But the look and the improvement in the curb appeal is huge. Just painting, trim. I mean, little really common sense cosmetic things that you can do that just dramatically. A lot of it's pretty well, duh. I mean, that makes sense. But the problem is a lot of people just don't do it. And
sounds like it makes sense, but I'll tell you what really is funny. We actually had our property management company tour a property we're in Kentucky. They did a beautiful rehab on the interior of 25% of the units, but the exterior, and they painted over. The paint's already peeling 4 months later, and the landscaping is a disaster. So It doesn't matter how nice the units look. By the time you got to get them through the landscaping, through that whole part, up into the units, and by the time their mind's already made up, So it's
you're exactly right. And it's funny you mentioned that about the paint peeling 4 months later. That's actually another little in a sense, little detail that can really mess you up is when you're working with the contractor, ask them what kind of paint are you going to use, right? Because there's just any old paint, but then there's also what we use is called Sherwin-Williams Super Paint. It will last for 10 years. Also, though, you have to ask them what kind of prep work are you going to do, because if you just throw paint on something and you don't prep it, we just toured a property where they had spent all kinds of money to this full paint job 2 years ago, and the entire thing is just peeling and bubbling like crazy. So if you don't so if you just go with the cheapest bid, that's probably what you're going to get. So don't, so even though obviously we're, especially in this market where everyone's fighting to save money and keep the budget down, make sure, that the cheapest bid might be too cheap for a reason. So, verify that you're getting good value. You don't want to, we're not looking for the lowest price. We're looking for the best value. And that's not always just a dollar sign.
I love that. Yeah. Cheapest is not most time never best. And it goes on all the points, paying poor for your contractors, paying lower wages, and that absolutely stands out if you want it, because you're taking on investors' money and you want to provide the best product you can for the people that live there. So absolutely, thank you for all those. And now I have a very important question, because I get this all the time and Peely gets this all the time. How do you work with your wife?
It's funny. Whenever I'm talking to people and they're like, and they find out, my wife and I work together, and they kind of give me that little so how's that working for you? Actually, it's great. It really is. I mean, we get to spend all day long, every day together, which I know to some people, unfortunately, that doesn't sound like an appealing thing, but for it is just, well, number one is you have to learn to trust each other. Right. And divide and conquer is what we call it. Say, okay, she has this and I have this, and, and we've built up confidence that, I don't worry about what she's got. I know it's going to be handled. I know it's going to be covered. I know it's going to be done. And then it's kind of, the same thing on my end of it's almost like, oh, hey, we got an offer accepted on another $10 million property. Great. So in one sense, it helps to, I think, not be in each other's hair too much, in the sense that you're not both trying to do the same thing. Figure out what you're good at and can trust the other person with, and kind of separate those things out. That definitely helps a lot. And yeah, doing what each person is good at. Like, she told me the other day, she's like, honey, just, let KFC make the chicken, right? So, don't split it up and outsource, and then take what you like and what you're good at. So
it's great.
And try to have extra grace with each other too, because no matter what, things can be challenging. So.
And that's absolutely great for any partnership, right? Is that you don't want to have two people that are both doing the same things, and it's just correlation. Like, just because it's your buddy and you feel like, oh, well, at least we can try this out together, doesn't mean it's the best option. Seeing what strengths you can bring to the table. But yeah, it was surprising that we really started to get that question more frequently than any other question, is how do we possibly work together?
Yeah. Well, and I think a big part of it is too, making sure that you have the same goals. Right. So if your idea is, we're going to get to, I don't know, $10 million net worth, right? And her goal is, well, we want to get to 20, but we're going to start 4 different businesses and do this and that. And you're like, no, we're just going to do it. That's going to cause friction and tension, right? So you basically both, and then that's a conversation to have very early on, and to keep having is making sure your goals are aligned and that you're heading in the same direction. Just that big picture piece will eliminate a lot of that friction and tension that I think people are alluding to when they ask that question of, well, geez, how do you guys work together? And, so.
Absolutely. Well, we appreciate that, and we appreciate other couples doing it. It's fun. It's really fun to do it with your partner, and especially when your goals are aligned. And so now, moving just to our last few questions, again, thank you for your time here. If you have a investor who's listening to this today and is trying to get started in this real estate journey, what is one actionable step they can take today to get moving?
Well, decide if you want to be passive or active, for one. So if you want to be completely passive, then that's when you talk to a syndicator, another operator, something like that. If you want to be active and be doing your own deals, first, go get David Green's book that I mentioned. Then also, if you want to do multifamily, go read Dave Lindahl has 2 books called Emerging Markets and Multifamily Millions. Read those 3 books. That'll give you a great foundation for just, it won't, you're not going to go do a deal after reading, well, you're not going to go buy 100 units after reading those 3 books, but it'll give you a good foundation. And then go out and start and pick a market. Figure out, well, where are you going to invest, right? And then once you have a market, say, well, what kind of properties fit my goals? Do I want to pick up a 10 unit and a 20 unit and self-manage them, and that's kind of my retirement? Or do I want to try to scale up and go 100 units or 200 units? And then once you have identified your market and then the type of deals you're gonna hunt down, start analyzing those deals, realizing that the first 100 you look at, you're probably not going to actually buy, but that's not the point. The point is you become good at finding a great deal by looking at 100 bad deals. And that's how you have to just learn by analyzing and doing. So I would take those steps, and that's a good way to get started.
That's great. That's great. Do you have a morning routine or something to set your mind right?
Yes and no. I don't find the morning routine to be quite as critical as I know a lot of other people find it is. But with that said, I'll wake up, try to do it a little bit before the kids do some prayer, do some stretching, do a little bit. I do have some, affirmations I read through. I'll do some reading or personal development. So like I'll, read the next book that I'm going through, and then I'll take the kids to school some days, and then come back and eat breakfast and go to work. So maybe a couple times a month I'll get up early and go surfing before we get to work. That always fires me up. What I described otherwise is kind of my normal routine.
That's great. And do you have some words you live by, or maybe an affirmation you'd like to share?
Let your yes be yes and your no be no. Basically, and that applies both in life and business. People say, well, geez, how do I get deals? And well, like when you're dealing with brokers, for example, if you say, I'll get back to you on Tuesday, get back to them on Tuesday. And even if you didn't, let's say something came up, and you didn't have a chance to look at the deal, reach out to them on Tuesday, said, hey, I really apologize. I didn't get a chance to do this, but I'll be back in touch tomorrow, right? Let your yes be yes and your no be no. If you say you're going to do something on Tuesday, do it on Tuesday. All those little things really add up. It's integrity, it's authenticity. It makes you easy to work with. It makes people want to work with you. So.
That's great. And so what was your favorite flavored popcorn that you made?
It would be one of the cheddar cheese ones, I think.
Nice. Enjoy that. Well, Andrew, this has been awesome. Thank you so much. You've shared a ton of wisdom with everyone today. And if people want to connect with you, hear a little bit more about what you're doing, where's the best place for them to find you?
Yeah, of course, I'm always, you can always do LinkedIn or Bigger Pockets, but if you actually want to start a conversation or actually really get connected, our website is, if you Google Vantage Point Acquisitions, it'll probably come up, but the URL is just V for Vantage, P for Point, and then acq.com. And there's a contact us tab on there. And if you just submit your information, that comes to my email, and then I'll respond back and we can go from there.
Andrew, thank you so much. This has been awesome. Really appreciate it.
Oh, you're welcome. It's great talking with you.
Great. Well, this is Jason with the Real Estate Investing Foundation podcast. Thank you for everyone who listened today. Talk to you soon. Bye now.
Thanks for tuning into the REI Foundation podcast. Check back next time for more awesome tips and strategies to launch your new you in real estate.